I'm Roger from PrecisionTradingSystems.com, and I'm going to show you this indicator, the Precision Divergence Finder. Basically, what this indicator does, it hunts down divergences from this demand index indicator. You don't have to buy demand index to use this because it's built into the system. So basically, with this setting, it's found the exact low point of 2009, which led to this huge move up. And as you can see, that's the only thing it found. Quite often when people plot this indicator, they think it's not working. But to explain what it's doing, it's got settings for the difference. So the difference is, if we're looking at 70, I'm just going to open this. So inputs, we're looking at demand index length 70, which is this indicator, and the difference we're looking for is 0.65. so what that's doing is measuring if this is greater than 0.65 difference from here to where it was 70 bars ago, it will produce a number here. So the number is 1. So if I change this to a smaller number like 0.3, we're going to find more divergences because there'll be more of them with the smaller amount. I'm not sure how many there'll be, but there should be some. There's another one which occurred here, September 2011, which is also another excellent signal. They're not all excellent, as I'm going to show you. Divergences are very, very dangerous things to put your faith into, and you must use a stop loss. I can't overemphasize that enough. So there's another one just recently. This one hasn't come to fruition. It still may, but usually when they work pretty quickly. So I'm going to change the settings to give you an idea. So we're looking for 0.1 difference now, and there will be more still. So the smaller number you put into the difference input, the more divergences you can find, but the less powerful they will be. So it's good to look at lots of different numbers until you find a setting which, when you apply it to your chart and your time frame, it produces the majority of the signals are good. So there's another nice signal here, 2010. So the bottom that we found earlier, the first one was here, and it's found others earlier which didn't work very well. This one's very good. There's a group of divergences, and here we can see that's kind of not so good, but this one's where the dangerous one. So those who buy without stops have a huge problem here, because the signal is given just after this goes back to 0, and the thing just went crash, crash, crash. 1300, this is the S&P 500, 1300 down to a low of 730-ish. So you can lose your shirt if you don't use stops, so that's something you have to do. You also need to give them space to breathe, and if you use a trend following exit, so you can take some nice profits. So now I'm going to show you what happens if we shorten the length. So demand index, I'm leaving it here. So if we look at length 30 and no smoothing, the plot will become much more, actually let's make it a bit shorter. The plot will become more volatile, so there'll be more divergences seen, and the numbers will be bigger, the differences. So you can, if you edit the Divergence Finder as well, length 30. Now if I leave this difference at 0.1, we're going to see many divergences now. If we scroll through, a lot of them will be of little use. A lot of them will be very good. So if we're going back to 1998, there's a splendid one. There's another splendid one. Another splendid one. This one is also right on the bottom. These ones are losers. This one is maybe a very small winner. And these are the ones that just keep going down. You will find a lot of them. There's nothing you can do apart from use stops. This is the one I showed you earlier, which you would have lost a lot of money with if you didn't use a stop. So as you can see, you've got to know what you're doing, and you've got to be very careful. But if you're a good trader and you know how to manage your risk control, you've got a good sense of where to put your stop and make the stop trailing. So here you could have bought with a stop of 20 points, trailing stop, and you would have made almost 200 points on the S&P when getting stopped out here. And the losing trades, you can lose 20 points again on them. So we're looking at a daily chart now. So we're going to make it more fussy. I'm going to show you what I would do. So we'll increase this to 0.5 and see what it looks like. So a lot of the signals have gone, but the best ones are still there. The bad ones are still there as well. There's another bad one. There's another bad one. And again, we make the difference it looks for bigger, 0.775. You can see one of these has disappeared. We've got a good one here. That's kind of half good and half bad. It's enough to make a little profit. And your choice of time frame is also quite important. You can put this on a 1 minute chart if you wish, and the signals will be many signals, and some of them will be okay, some of them won't be. But the point is, there's a lot of junk when you're looking at that shorter term time frame, and it's important to understand that if you're looking at like a half an hour chart or an hour or a 4 hour or a daily or weekly, the signals will be much more significant, because it's not just market noise. The long-term trends and price action have a lot more meaning. So by making it stricter, we've stripped out a lot of trades, and we've kept some of the good ones here. There's a whole group of them of this area, which led to a very big move up. And then here, this one you could have maybe stopped out if the stop was tight, or you could have made a small profit. And then here, this is a nice one, nice move up. And this one's just occurred a few days ago, and we don't know what's going to happen with that yet. I'm going to show you a few other things now. Okay, this is the alert window. The indicator comes with alerts which you can enable or disable depending on your preference, and it will display the symbol and the time frame. So if you've got a lot of charts open, you can see which one it is. So this is the FTSE 100, and I'm going to plot the indicator. This time length 50, and the difference we're looking for is 1. I'm going to turn the alert off so we can look through, and you can see there's nothing because the difference it's looking for is too big. So we go to our indicator and we adjust 0.8. Then look through again. This is the best way to approach this. There we go. So there's a very good. This is a very small winner or a very small loser, depending on how tight your stop loss is. This one here led to a huge move up from 3,430, and it went a long way up. So this one trade would pay for a whole bunch of losers, and that's the best way to approach this. So there's only 2 signals there. Now let's make it look for 0.7. So it's found those same 2 signals again, and another one which was a small loser. It's interesting, there were more divergences here than here. So you can see this is 2.1, so that means it's found 2 divergences here and 1 divergence here and here. It goes up to a maximum of 20. You would think that the higher the number, the better it is. That was the idea, but it doesn't always work like that. Sometimes you only get 1, and 1 can be very effective. So now we're going to make it less strict. So it's still got all those 3. We go back in time, there's nothing. And then forward in time, there's one which was absolutely on the bottom of a nice move up, and another one which is recent. Let's just see. Eventually I'll get there. That's interesting. This occurred on the same bar as that one we just looked at on the S&P 500. So everybody thought the trouble was over, and this signal failed, and it's gone down more. So let's go less strict. So what you're going to notice is that there's a kind of sweet spot that you can find where most of the signals will be good and there won't be too many bad ones. I'll go back to the beginning. Start at the beginning, that's the best thing usually. I'll get there eventually. Okay, that's the beginning. Back to 1997. This is Brown Monday. It's a day which I will never forget. So here we have 2 divergences, and they were both 2. This led to a very small move up, which later went lower. Here we have another 2 next to each other, and you'll often find that they come in little groups, not always just one. So there's another nice move up, but not particularly huge. This one was much more impressive. Very big move up. Excuse me, I'm getting over my cold. So this is a new signal, we didn't see that last time. So we've got 1 divergence here, again absolutely right on the low. and the move was very impressive that came from that. And here in 2011, another move of kind of average size. So let's go and make it much less strict again. Let's go 0.4, and you'll see more signals coming. So we've just picked this one up, it wasn't there just now, a small winner. And going backwards in time, I think that was there before, that was there before, these were there before as well. That's a new one, very small winner or a very small lose depending on your stop. To give you a suggestion for best use, even though it seems logical to buy immediately once you see the signal come, if you observe carefully you can see that if the trend is down, let's just put this here, so here the trend is clearly down and it's catching a falling knife. If there's only one or two in your portfolio it can be okay, but Ed Sakota wisely said once, the problem with catching falling knives is there's more knives than you've got fingers. And what he means by that is if you've got a bunch of stock, like 50 stocks in your portfolio, and you get a load of trades like this all flashing up one after the other on one day, if you take all those trades you could have a very bad day. So it's inadvisable to take a whole load of highly correlated trades at the same time in trading in general, but with this product it's even more pronounced. I'm going to repeat myself and tell you that it's very dangerous to use this product without stops. It's actually madness, but if you know what you're doing you can do very well. And what you can do is when the trend is really down you can plot a moving average, maybe 5 or 10 period moving average, and then after you see your divergence coming, say like this one is falling and it's still falling, and then here somewhere around here the moving average would show the trend has changed and it's backed up by divergence to just a few minutes, a few bars earlier, and that's you get a worse entry price, but you would remove a lot of these bad signals. I've left it completely unfiltered because a lot of people are quite sophisticated and they know what they're doing. So just going to make it more easy. 0.2, so we'll see more signals which are not good, but there'll also be some good ones coming. As you can see, there's a few more, some are good. There's another beautiful one, and this one was not beautiful. Demand index is another product which I've got available from MultiCharts, but if you use it on its own, if you don't know what you're doing, you won't find it of much use. But if you use it to look for these divergences, it's very useful. There's a lot of different signals you can use with it. One of the most obvious is the crossing of 0 as a significator of an uptrend, and the crossing below 0 as a downtrend. And you've got the extreme peaks and extreme lows. So here's an extreme low. So the theory is that if there's an extreme low in the price and an extreme low in demand index, there will be another lower low following shortly, and vice versa. It doesn't always work. There's one that didn't work. I don't want to confuse you, so I'm going to take that off. That is one of the best indicators I've ever used for finding divergences, because it gives you another dimension when you're using volume instead of just price. It's a 4-hour chart of the US dollar against the South African rand, and I've set this to 20, the length which is looking at, and the difference we're looking at is 0.3. So there's these two signals here where there's been a tiny move up. Obviously that's present day, so I don't know what's going to happen. Here we've got a beauty right at the bottom, followed by a huge spurt and this is often a very good way of spotting insider dealing. People know what's going on and they're quietly buying without trying to move the price up, buying in a falling market. And especially if you trade stocks, this indicator is very, very useful for that. Okay, so there's one which was a slight loser, or if you had a wide stop you'd still be in. Another nice move. And here's a close up, another example, some clever buying and then taking profit straight away. They got some money there. And another example, very close to a nice move up. And as we go back, you can see here and here, and you can get an idea how it works. Some of the signals are amazingly good. Some of the signals will be terrible, such as this one. Just after you buy, go straight down. Failed signals are often a good thing to use to reverse your trades, although it takes a special type of person to be able to first admit they're wrong enough to close their trade and also then reverse it straight away. It's not easy for everybody to do, but those of you who can will do better than those who can't. It's the ego in trading is usually a very bad thing. These signals always come on the lows. That's why they look so spectacular, because the idea of it is if the price is making a new low and demand index is not making a new low, then something's going on that's worth looking at. This is the precision divergence finder on the Australian dollar versus the American dollar, and the length for demand index is 40 and the difference is 0.8. This is the ideal kind of signal, downtrend, sideways, slightly lower low than this and this, but there was one divergence, made a lovely move up. So it does work in a 1 minute chart, but the signals will give much smaller moves, like this one, which is very small. And this is a rather mediocre signal, but slightly profitable. And this is one of the signals that you have to be careful of. This is why you must use stops. This is the Swiss franc versus the Norwegian kroner, and the settings are demand index length is 30 and the difference looking for is 1. Start at the beginning as usual. This is one divergence which led to a big move up. This is a whole bunch of them together, 4, and then shortly followed by another one of 1, which led to another big move up. And this looks like some news announcement here, and this is a classic case of people who know what's going on in advance of time quietly build in positions. This is something you see all the time in the stock market. There's another one. This was 2, another nice little move. And let's change the settings to 0.6 so we can see more signals. Go back to the beginning again. This is a new one, another nice move, another move here, another move. This is a 4-hour chart, so the signals are better and the moves are bigger. So before this and this, there was another one here, so if you had a wide enough stop, that would have been a nice profit there. Sometimes they do come in groups. Precision Divergence Finder doesn't come with sell signals, it's only buy signals, and this is because the psychology of a market bottom is completely different to the psychology of a market top. It would take me quite a long time to explain in detail, but basically tests I did, it wasn't so easy to predict a top with any great reliability.